At Acuity Wealth Management, we've taken the investment strategies created by the world's smartest minds, including Nobel Prize winners, and democratized them for the everyday investor. But with that, we also need to provide educational tools so all can understand and embrace them. Please sit back and enjoy our brief video presentation, How Would Einstein Invest? This first slide's titled, A Tale of Two Investors. We're looking at the 30-year period ending December 31st, 2013. On the left, the S&P 500 Total Return Index, which is a broad-based index of U.S. stocks, returned 11.11% per year. Next, we have the U.S. Aggregate Bond Index. It returned 7.67% per year. But the average individual investor only managed a 2.49% annual return, while the average institutional investor returned 10.61% annually. Let's introduce Albert Einstein with one of his famous quotes. The definition of insanity is doing the same thing over and over again and expecting different results. So why does the average individual investor only capture 37% of the available return annually? Here's a perfect example. At the end of 2010, Morningstar announced that the CGM Focus Fund was the mutual fund of the decade. The manager, Ken Hebner, had returned an astonishing 18.03% annually, easily beating the S&P 500's 0.55% annual loss. But wait. After Morningstar calculated the dollar-weighted returns, the average investor had lost 13.73% annually. Why did this happen? The fund would have a great run, and investors would pile in. But then there would be a dramatic decline, and they'd flee. It's obvious you don't want to use emotions when you're investing. You do want to use science, though. It's been reported that late in his life, Dr. Einstein was giving an interview to the press and was asked, Dr. Einstein, what is the most amazing discovery mankind has ever come up with? His response, compound interest, but it can work for you or against you. So how can compound interest work against you? It's a simple fact. If you drop 50%, you'll need to go up 100% to get back to even. But if you drop just 10% more, and fall 60%, you would then need to go up 150% to get back to even. These types of declines do happen, and they happen more often than you might think. The Japanese Nikkei topped in 1989, and to the bottom in 2008, it fell 82%. The Nasdaq, it topped out in March of 2000, it dropped 78% to the bottom. And the most recent financial crisis, the S&P 500, from the top trade to the bottom trade, fell 57%. Getting compound interest to work for you is actually a lot easier than you might think. We're looking at two indexes here for the period of January 1999 through March of 2014. In red, we have the U.S. Aggregate Bond Index, and in green, the S&P 500 Total Return Index. You could have bought either one, or you could have tried to jump back and forth like the average individual investor. But let's just see how we can use rebalancing to take advantage of compound interest. Let's say you put 50% of your money in the S&P 500 and 50% in the bond index and simply rebalance back to that 50-50 on the last trading day of every year. You would have ended up with a blue line and actually more money than either one of the two indexes. Let's bring Albert Einstein back in again. He dubbed compound interest the eighth wonder of the world. So how do the world's smartest minds invest? This chart is that same period, January of 1999 through March of 2014. Again in green we have the S&P 500 Total Return Index. But this time in blue we have 10 indexes that are rebalanced annually on the last trading day of every year. We've broken the chart into different times when the stock market goes up and times when the stock market goes down. You'll notice that when the stock market goes up, the blue never goes up nearly as much. But when the stock market goes down, again, the blue never goes down nearly as much. The end result? The 10 indexes rebalanced annually created significantly more wealth than the S&P 500. This time we're going to bring Warren Buffett in for a quote. The First rule of investing is don't lose money. The second rule is don't forget the first rule. For a secure retirement, who should you invest like? A, your average do-it-yourselfer, or B, your average institutional investor. Thank you for joining us in this brief video presentation to explore the science that Acuity Wealth Management uses in our goal to take the least amount of risk per unit of return when working with our clients' hard-earned wealth.